Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we are going to be looking at a pair of things today. We actually have quite the eventful set of numbers here over the coming day, especially considering that US CPI release really didn't move the needle too much. It certainly created a bunch of back and forth volatility in markets, but it didn't really seem to create a whole lot of conviction. So markets not really going one way or another here ultimately. And so with that in mind, there's an opportunity for some of these other releases that we have on the docket to move the needle, perhaps, and get a little bit more of a reaction function here from investors. And so the first thing that we are going to look at, of course, is going to be U.S. retail sales. And then likewise, we also have a UK CPI release due here overnight, which could be something that gives us a bit of volatility. We'll talk about why that might be the case and what that could mean more broadly for the markets. So let's get into both of these things. We'll begin with U.S. Retail sales here. First, let's look at the expectations. I mean, clearly there is a meaningful rebound that's expected here. We can see a very strong 1.8% rise expected. That's, of course, a far cry from the 1.1% decline in the prior month. And really the key number here that we're going to be looking at, because the month-on-month survey is a little bit volatile in terms of understanding the sort of larger story here, is the story at the year-on-year basis. That's not usually the market-moving component of this release, but it's the one that ultimately figures into the overall sort of macro narrative. So let's see if we can't get a sense for how we're positioned ahead of this and see if maybe it'll create a bit more of a response than what we've seen from US CPI. But just to get a sense for where we are, the CPI number was a little bit warmer than the prior month, not quite as warm as perhaps anticipations had it, but nevertheless, a bit warmer. So the number that we saw here expected for the year-on-year core was 5.7. We got 5.6, a little bit lighter, but higher than the 5.5 in the prior reading. Similar with the headline number. The actual 6.4, expectations were 6.5, a little bit lighter there, but up from 6.2 in the prior month. Very similarly, the setup here for policy rates, a little bit higher in the wake. So you can see the yield curve has shifted up a bit. Now looking 6 months out, we're looking at a peak in rates at about 5.3. So markets almost flirting with getting north of that 5 to 5.25 range for the Fed funds rate, but not a huge move here. A little bit higher and north of 5%, it looks like, going out 1 year, but not a dramatic change. Leading into the release, some interesting leading indicators. So on the one hand, when we look at The latest, this is as of last Friday's University of Michigan Consumer Confidence Survey report. You can see the yellow line there is the overall index, higher over the past 2 months, and the new orders component of services ISM substantially higher into January. The current conditions index in that consumer sentiment survey from the University of Michigan, strongly higher, the highest it's been in almost a year, it looks like. So definitely some very powerful indications that there is retail growth and the consumer is fairly healthy here. Certainly not offsides with the very strong non-farm payrolls report we've just seen, the very brisk pickup in job openings that we saw in the JOLTS data for December, and of course, job openings looking strong for December would be logically followed the following month by strong jobs growth and a more confident consumer. All of that seemingly making sense. The fly in the ointment here is this Red Book same-store sales number, which is direct retail sales leading indication here, sinking. That's the year-on-year rate assessed on a weekly basis, and what we're looking at here is significant deceleration. Not on the chart here is survey data from S&P Global looking at growth in the retail sector, suggesting we've had contraction last month. So some conflicting indicators here, and as we saw with CPI, the makings for volatility. Because as you get these kinds of conflicting indicators, you likewise get people on both sides of the argument. And then when the number invariably comes out, portfolios have to readjust, and we need to see essentially those folks that didn't get the number correct make a shift, which then gives us volatility. Looking at the overall U.S. economic surprise indices, just to get a sense for what is the likelihood of an upside surprise relative to forecasts, it does seem like in the wake of a jump following that NFP report, which is that surge you see in both economic surprise indices from Citi and from Bloomberg as well here, the situation looking a little bit more staid. Not surprising, of course, considering the biggest release since then has been CPI, and it was kind of a middling outcome. But nevertheless, it does appear to be the case that U.S. economic data in the current environment has a tendency to surprise cautiously higher, which means that economists' models that give them the forecasts for the economy as it stands are skewing a bit softer than reality has validated. So that would certainly give us a bit of hope that we could have an upside surprise here. And of course, the upshot would be, as we saw in the wake of CPI today, a stronger dollar, a little bit of a wobble in stocks, a little bit of a wobble in gold. The interesting thing that we saw today was a relative lack of conviction. A lot of those anti-dollar and risk-favoring assets had a big rally ahead of CPI. And so what the subsequent reversal did was basically give us unchanged results thereafter. So S&P 500 basically flat, the dollar basically flat, gold basically flat on the day, even as we've had a spirited rise in yields and as we just saw, looking at the yield curve here, an upshift. So with that in mind, as we look at the overall Fed structure and see, well, is it possible that this retail sales number could give us a bit more conviction? We continue to focus on that middle column, the percent of a hike or cut that has been fully baked in. And we can still see quite a bit of dispersion, quite a lack of conviction beyond what is expected to happen in March. We can see that the likelihood of a hike in May has perked up a bit, and between May and June, it certainly looks like we're going to get into that 5 to 5.25 range, but exactly when is unclear. And most importantly, the likelihood of cuts in the back half of this year showing a lot of dispersion. So still seemingly a lot of room for markets to reprice and react to what could be a moving target. Now, after this retail sales report, the next semi-significant shoe to drop is going to be FOMC minutes next week, mid-next week. So in the interim here, there's going to be a relative calm in terms of macro event risk, and that may be revealing. It'll be interesting to see, regardless of how retail sales comes out tomorrow, what overall risk sentiment is going to look like and what the market's default is after the key event risk immediately in front of investors is in the rear view. With that, let's shift focus here and look at the UK, because here we could have a catalyst for meaningful movement as well. So what we're going to be watching is the CPI release, and the expectation, as you can see on the chart here, for the headline in the red and the core in the sort of darkish bluish gray, is a further decline, going down to 10.3 on headline, going down to 6.2% year on year on core. Now, as we like to do here on Macro Money, I've lagged these against baseline expectations baked into the bond market. So the yellow bars you see in the back there are the 5-year break-even rate. That's the difference between 5-year nominal and inflation-adjusted bond yields, which of course gives us the magnitude of that inflation adjustment, and suggests what the bond market expects inflation to be in 5 years' time. So when you look at this, you see that the 5-year break-even seems to have topped already and has been heading down since. If we lag 6 months realized CPI, which of course is going to lag market expectations, markets themselves are forward-looking. They anticipate what happens in the macroeconomy, and of course, because of data collection limitations and the lags therein, CPI is even more lagged than arguably economic conditions are relative to what investors expect them to be. So that adds up to about a 6-month lag. Looking at this then would imply that maybe we've peaked on UK inflation already. And if we get these numbers coming in lower, perhaps even surprising on the downside, we could have a bit of market volatility, because this is not where investors are. So first, let's look at how likely is it that we get a surprise on the downside. So first, looking at the Citi Economic Surprise Index for the UK, we see that it has in fact been looking increasingly dour. So we can see here that we're, first of all, sub-zero, which means that economic outcomes tend to be underperforming relative to baseline forecasts. And of course, we also see that really for the past several months, this has been sinking like a rock, which means that analysts' expectations for how the UK economy is actually doing have been substantially rosier than reality has validated. And so there is seemingly a potent case here for a downside surprise. It gets worse when we filter out the data to be just inflation data, so just on numbers that are tracking the growth of the inflation side of things, and this is not just official figures, this is leading indicators as well, we can see a very significant decline. Now, still something that is tending to be above zero and thereby nominally surprise to the top side. But of course, these are monthly numbers. They don't alter that much, not nearly as fluid of a series as the overall number here. This is a daily chart where each point is a day. This is a monthly chart where each point is a month because, of course, this data only comes out at that cadence. But here, again, notable contraction in the ability for these outcomes to surprise above expectations. And so a vulnerability, as it were, to seeing something that is weaker than anticipated, which of course would be supported by the latest readings on economic conditions. What we see here is that the UK economy is still shrinking. These are the latest Purchasing Manager Index surveys for the UK. We can see here all sub 50. Now, just to quickly remind, I like these PMI numbers, so I use them a lot, and I'll probably keep this reminder going on and on, broken record-wise, for anybody that might be uninitiated. But it's a great set of indicators. It works on a logic whereby 50 is neutral, above 50 marks expansion in the relative sector, be it services or manufacturing or the composite of both. The farther you go above 50, the faster that expansion. On the flip side, under 50 is contraction, and the further you go under 50, the faster the contraction. As with most major developed economies, services are a much bigger element in the overall pie than is manufacturing. It accounts for close to 3/4 of the economy. And you can see here, worryingly, in January, services not only was still in contraction territory, but actually accelerated in that way. Manufacturing picked up a bit, but still in contraction as well, just at a slower rate. And then the overall composite on net contracting faster in January than it did in the prior month. So the takeaway here, still a soft economy, which should not be generating outsized inflationary pressure. With that in mind, we look at where the aspects of this might be generating of volatility, and it's the yield curve. So consider here the shift in the UK yield curve since the last BOE policy announcement, which of course was just 2 weeks ago. You can see the curve has shifted meaningfully higher. The dotted line there is where the curve was immediately after the Bank of England. The curve in solid line is where we are as of today. And you can see the peak has meaningfully increased. So we're still expected to peak out in about 6 months' time. So call it somewhere going into the third quarter, perhaps maybe even the middle, July, August, something like this. And as we look at that now, we ask the question, well, if CPI is going to keep falling, if we're going to keep seeing weakness in the overall economy, if everything that we're seeing suggests, as we saw on the chart just here, that maybe inflation has peaked already and economic conditions relative to forecasts are weakening, especially on the inflation side, and the overall economy is still in contractionary territory, then does this upshift in the yield structure make sense? A soft CPI number would certainly make that rise look a bit suspect. If that's the way that this goes, well, then there's room for markets to re-examine what they've done in the past 2 weeks, with, of course, consequences for the markets. Now, it's possible that we could get a bit of a lift for UK shares against this backdrop, but the British pound seems likely to be on the chopping block if we're going to get this kind of correction. So we, of course, have had a bit of a lift recently in the pound. So if you're looking at 6B, which is the contract here for British pound futures, then what you've witnessed, let's say, in the past several weeks, really from September onward, as we got some of the political crisis off the books there, a meaningful rally. So from the lows in September, we'll call it late September going into October here, that was about 103 on that 6B future, up and into the recent highs, a rise of almost 20%, 19.8%. And we've held since in a range from about, let's call it mid-December through to now, with support around 118.60. If we were to get a soft CPI number here that were to give us a downward shift back in this yield curve in line with some of the leading indicators that we're looking at, it is certainly within the realm of possibility that the British pound gets a meaningful lurch lower and takes out that range support, in which case there might not be a whole lot of air left in this rally, and we might be heading meaningfully lower. Something to keep in mind here as we track the overall global economy and whether the fate of the U.S. dollar as relative to some of these major currencies is starting to look a little bit better. Certainly the Fed was out front on starting to downshift a little bit the rate hike cycle, but immediately in its aftermath, it seems like some of these other central banks, the ECB, the Bank of England, might be starting to follow suit, which would undercut some of the recent dollar weakness, even on yield spread grounds, and perhaps give us a little bit of a lift there. That, of course, can be a sign of a bit more of a risk-off tone, which can extend to other assets if the circumstances are right. Correlations are, of course, something that wax and wane. So even as we look at the correlations being strong between the dollar and overall risk sentiment, certainly as reflected in stocks, it's important to remember correlation is not causation. So which way these relationships run causally is not necessarily a given. And also, we don't necessarily have a world in which correlations always hold and never weaken or never change. They certainly do. But as we look at some of these other central banks, maybe considering that conditions have weakened enough that they need to dial things back, the takeaway might echo back into broader markets, into a sense of the global economy slowing and inflation weakening, and central banks actually starting to think in a different direction, which of course would be a contrast if U.S. economic data continues to surprise higher, creating divergences, creating volatility. And this has been today's edition of Macro Money. Again, I am Ilya Spivak, head of Global Macro here at tastylive. We do this show 4 days a week, Monday through Thursday, just on the heels of overtime with our good friend Chris Vecchio, head of Futures and Forex here at tastylive. If you want to catch my various thinking about markets outside of those shows, you can follow me on Twitter at Ilya Spivak. Thank you very much for joining, folks. We'll speak to you tomorrow. Take care.